Hi, I'm Logan, and in today's video, we're going to be going over how to calculate the basis of intangible assets, including organization costs, startup costs, and loan costs. Now, if this is the first thing you're seeing from SuperfastCPA, our main study approach is using the questions as the main learning tool, or questions first. So that's what we're going to be doing today. We're going to be diving straight into some questions to learn how to calculate the basis of these intangible assets. If you want to learn more about our strategies, we have a free webinar training at SuperfastCPA.com. The link looks like this. It will be in the description. It's a free 1-hour training webinar, and we teach the 6 key ingredients to passing the CPA exam. One more thing about this video. This is the free version where I will be going over 5 questions, but Superfast CPA members will have access to the full video that goes over 10 questions, again learning how to calculate the basis of these intangible assets. All right, with that said, let's dive straight into some questions. Fish Ltd. has completed the acquisition of a competitor and recorded the following items: brand recognition of $50,000, manufacturing equipment of $100,000, a license for a proprietary process valid for 15 years for $30,000, and goodwill for $20,000. The company is evaluating which of these costs can be included as intangible assets for the purpose of calculating amortization for tax purposes. Which of the following represents the correct total basis of the intangible assets acquired? Okay, again, we're using questions as our method of learning how to do this. Take a second, pause the video, make sure you understand what the question is asking, and when you're ready, come back and we'll go into the answer to start learning. All right, here's the answer. $100,000. Okay. The manufacturing equipment is a tangible asset. That makes sense. It's like actual physical equipment and is not subject to amortization as an intangible asset. Brand recognition, the proprietary license or process license, and goodwill are all intangible assets that can be amortized for tax purposes. Okay, so this is obviously a physical asset. It's not going to be an intangible asset. But the rest, $50,000 plus $30,000 plus $20,000, totaling $100,000, that will all be counted as intangible assets that will be amortized. So that's pretty simple. That's the basis, the total basis of all the things that are going to be amortized here. So that's a pretty straightforward answer. So basically, goodwill, a brand, or a license for a certain process, those could be considered intangible assets. All right, that was a pretty simple one. Let's go to the next one and see what else we can learn. All right, here's the next question. Horizon Partners, a calendar year taxpayer, began its business operations on April 1st, year 1. Or did it? April Fools. No. In the process of starting up, the partnership incurred the following costs in year 1. Attorney fees for drafting the partnership agreement, $3,000. State filing fee for the formation of the partnership, $2,000. Market research costs before operations began of $48,000. Advertising costs for the grand opening campaign, $4,500. Salaries for training staff prior to opening, $1,500. Okay. Horizon Partners is electing to deduct the maximum amount of startup and organizational costs allowed. Okay. So right there, this is going to be something a little bit different. Apparently there's an amount that we can deduct immediately instead of amortizing when it comes to startup and organizational costs. So we need to learn what counts as a startup cost, what counts as an organizational cost. What is the total amount of startup and organizational costs that Horizon Partners can deduct and amortize for year 1? So we need to figure out what is deductible and what needs to be amortized. Maybe you already know something about this. Pause the video, see if you can figure it out. But if you haven't really seen anything like this, we're just going to go straight into the answer. All right, the answer is $5,000 of it can be deducted as organizational costs, $1,000 of it can be deducted for startup costs, and $53,000, so the rest, will be amortized. So let's learn what goes into a startup cost and organizational cost. The total organizational costs are $5,000. So apparently attorney fees and state filing fees. So that kind of seems like, legal stuff type of a thing, which is, so those count as organizational costs. So that seems like something that would be, to be able to organize, not necessarily to start the business, which will be some other stuff that we look at, but just to legally be organized as a business. And then the total startup costs are $54,000. So that's the market research, the advertising, and the salaries before they opened. If the company elects to deduct the maximum allowable amount for startup costs and organizational costs, they can immediately deduct up to $5,000 of startup and $5,000 of organizational costs in the first year, provided that the total costs for each do not exceed $50,000 respectively. Okay, the remainder is amortized over 180 months. However, if the total exceeds $50,000, the immediate deduction is reduced dollar for dollar by the amount that exceeds $50,000. Okay, so let's read a little bit more into this before we talk about it. Since the startup costs exceed the $50,000 threshold by $4,000, so these three expenses, 48 plus the 45 and 1500 equals 54, but it's $4,000 over 50,000. The immediate deduction of $5,000 for startup costs is reduced by $4,000, leaving an allowable immediate deduction of $1,000. Wow, okay. The remaining startup costs to be amortized are $54,000 less the $1,000 that's immediately deducted, so that's $53,000 that will be amortized. These costs are then amortized over 180 months, beginning with the month in which the business begins. The immediate deduction for organizational costs is not subject to reduction because the costs did not exceed $50,000. Therefore, the entire $5,000 can be deducted in the current year. Okay, so right there, that question had a ton that we could learn from it. So first off, organizational costs like legal things like attorneys, state filing, things like that. And then startup costs is basically like the costs to get you off the ground, like researching what you need to do, advertising that you're about to start, paying people to help you like before the business actually opens, and then they can each have $5,000 immediately deducted. So $5,000 for startup costs, $5,000 for organizational costs, and then the rest is amortized. But if the total startup costs is over $50,000 or the total organizational costs are over $50,000, the immediate amount that can be deducted is reduced dollar for dollar by any amount over the $50,000. So if you had $55,000, you would not be able to take the, or more, obviously, you would not be able to take the $5,000 immediate deduction. And so in this case, I'm just kind of going over what it already said here. Since this total was $4,000 over the 50,000, that $4,000 reduces the $5,000 that can be immediately deducted. So only $1,000 is immediately deducted, leaving the remaining 53,000 to be amortized. Okay, so that makes sense. So the organizational costs, all $5,000 can be immediately deducted, so nothing's going to be amortized. $1,000 is of the startup costs is immediately deducted, leaving the remaining $53,000 to be amortized. And one more thing to point out, it looks like they would be amortized over 180 months, which would be, I believe that equals 15 years. Yeah, 15 years. So that's just one more thing to kind of keep in mind. It looks like these intangible assets are amortized over 15 years or 180 months. All right, we learned a ton from that question. So let's go ahead to the next one and see what else we can learn. Here's the next question. On July 1st, Kesar Technologies Inc. acquired a small tech firm and, along with it, an exclusive software license that is valid for 10 years. Additionally, Kesar paid for a patent that has a legal life of 20 years, but they expect to use it effectively for only 12 years due to rapid technological advancements. Assuming no election is made to use the alternative depreciation system, what is the correct amortization period for these intangible assets for tax purposes? This one could be a little bit confusing because we're thinking, well, it says it's only valid for 10 years, and this one's only going to be usable for 12 years. So wouldn't it just be that? But maybe there's something different when it comes to tax purposes. So take a second, read it through, make sure you understand it. Maybe you already know the answer. And when you're ready, come back. We're going to look at the answer. All right, let's go ahead and look. So 15 years for both the software license and the patent under IRC Section 197. So this must be a special tax rule. It would be 15 years for both the software license and the patent under IRC Section 197. Under the Internal Revenue Code Section 197, certain intangible assets acquired in connection with the purpose of a business are required to be amortized on a straight line basis over a 15-year period, regardless of their actual useful life. This includes purchased patents and software licenses, but does not apply to certain self-created intangibles or to intangibles with an indefinite useful life. Okay, so right there it says that for a lot of intangible assets, and in this case specifically software licenses and patents, when it comes to taxes, they, regardless of what their useful life is, have a 15-year amortization period. So obviously, again, there may be some exceptions to that, like something with an indefinite useful life, such as a trademark that you are planning on indefinitely renewing forever. So it doesn't really have a useful life, so there's no point in amortizing it because it won't end. Or obviously, self-created intangibles. Those things would not necessarily fall under this rule, but the vast majority of stuff you're going to be seeing in the CPA exam will fall under, they're trying to test you on this specifically. So again, intangible assets mostly under tax law have a 15-year amortization period. All right, so let's go ahead and move on to the next question. All right, here's the next question. Apex Innovations Inc. incurred several costs while acquiring a subsidiary. These costs are detailed as follows: customer list purchases for $30,000, patent acquisition costs for $50,000, loan origination fees for financing the acquisition for $10,000, and legal fees for drafting new service contracts for $8,000. Assuming that Apex Innovations Inc. can capitalize and amortize these costs, which of the following amounts would be considered the initial basis for amortization of these intangible assets under the Internal Revenue Code? Okay, so from what we've learned so far, most likely customer lists going to count as an intangible asset. Patent, we just dealt with that in the previous question, going to be an intangible asset. Now the question is, are loan origination fees for purchasing going to be counted? And then also legal fees. Now legal fees, when it was a startup or an organizational cost for starting up a business, it was considered something that you could amortize potentially, but I don't know if it's going to be amortizable when you're just purchasing a subsidiary, acquiring another business. So take a second, think about it, come back when you're ready. All right, let's go ahead and look at the answer to see what all these will add up to be. Okay, so $90,000. So it looks like it's going to be these three up here. 30, 50, 10 equals $90,000. So customer lists and patents, like we said, are typically considered amortizable intangible assets. Loan origination fees are also amortized over the life of the loan. Okay, so loan origination fees looks like those are intangible assets typically as well. Legal fees for drafting contracts are not an intangible asset, but rather an expense related to a service, which may be expensed or capitalized depending on the specific circumstances and nature of the contracts. And since we don't have any other information what the specific circumstances are for these legal fees, we're just assuming those are expenses. Maybe it would give something more specific in the future, but but in this situation, it looks like just the legal fees are expensed. Now, something I want to point out is, there may be situations where loan fees maybe aren't amortized, but they're very limited, like very specific, and probably will not be tested on the CPA exam. So, as a general rule, loan origination fees are an intangible asset that will be amortized. So that's why we're including them here as part of the total basis. Now, they may have a different they may have a different useful life, or they may have a different life than 15 years. It doesn't specify that here. So again, the basis that we're assuming is $90,000. All right, let's go to the next question. Pioneer Partners, a calendar year partnership, commenced its operations on June 1st, 2023. In starting the partnership, the following expenses were incurred and paid in the year 2023. So legal fees to become a partnership, state filing, marketing study costs for $7,000, consultation fees for potential market analysis, $9,500, travel expenses for scouting potential business locations. Pioneer Partners is determining the deductible amount for organizational and startup costs for the 2023 tax year. Assume the partnership has not incurred any other additional startup costs, so they're all listed here, and has elected to deduct the maximum allowable amount under current tax law. So we already learned that from before. They want to deduct the maximum of $5,000 for startup costs and $5,000 for organizational costs. What is the maximum amount Pioneer Partners can deduct immediately for the 2023 tax year, considering both organizational and startup costs? So we're already 5 questions in. Let's think about this maybe before we go to the answer. So from what we've seen before, legal fees and state filing probably going to be organizational costs. So that does look like it's over 5,000. So probably a full $5,000 will be able to be amortized there. Sorry, deducted there. And then 7,000 plus 9,500 plus 3,800, that looks like that's also over $5,000. So what so again, we want to know what amount can they immediately deduct right there, right away. We know probably $5,000 for startup costs and $5,000 for organizational costs, and then the rest would be amortized. But it's not asking about what the amount that is amortizable afterwards. It's asking what amount can they immediately deduct. And again, it's immediately deduct because that could catch you in another question on the CPA exam. So make sure you pay attention, and you'll learn this in another section of the blueprints, how to calculate the amortization every month. But in this section specifically, we are just learning about the immediate deduction. So when it says what can they deduct immediately, it's asking about that $5,000, not necessarily about the rest that would be amortized throughout the rest of the year. So we pretty much already know the answer, but if you need to, pause the video so you can kind of think about what I said and read through this one more time. And when you're ready, come back and let's look at the answer. All right, let's go ahead and look at the answer. So we already kind of went over this, but let's go ahead and read through it. The correct answer is $10,000, assuming the partnership elects to deduct and the costs do not exceed $50,000 each for organizational and startup expenses. This represents the maximum immediate deduction of $5,000 for qualified organizational costs, such as legal fees and state filing fee, and $5,000 for startup costs, such as the marketing study, consultation fees, and travel expenses, as allowed under the tax law, with any amounts over $5,000 subject to amortization over 180 months. The other options do not accurately reflect the allowable immediate deductions. And obviously, we also know, it didn't state this here, but over $5,000, it can be amortized. But if it's over $50,000, that immediate deduction starts getting reduced. So that's something that we can remember from that. All right, before we go any further, let's do one more part of the process, which is pillar topics. Now, if you're unfamiliar with the SuperfastCPA CPA strategies, one part of the process is something called pillar topics, where you take the 2 or 3 or maybe even 4 main topics that you learned from doing the questions and write them out so that you know, okay, from this section and from these questions, this is what I was supposed to learn because this is what I saw from the questions that I did. So let's go ahead and list out a few pillar topics. So first off, something really obvious, $5,000. $5,000 can startup costs and organizational costs can be immediately deducted each. So that's not total. That's $5,000 for startup costs, $5,000 for organizational costs each. However, this would be reduced by dollar for dollar for everything over $50,000, meaning that if you had a total of $55,000 or more, there would be no immediate deduction. Oh, that's all right. We'll fix that. There we go. Okay. And then, so that was dealing with like the startup costs and the organizational costs. Intangible assets typically include goodwill, patents, brand. Let's see. Let's think of one more thing. Customer lists. They are amortized usually over 180 months, 15 years for tax purposes. But again, so those would be the pillar topics, the main things that we learned from this. You can be a little bit more detailed if you want, but doing the questions first allows you to see it firsthand, and then you can kind of pull out the concepts that you were supposed to know and learn so that you can apply those later. All right, that's the end of the 5 questions. Again, in this video, we're only doing 5 questions, but Superfast CPA members will have access to the full video where I go over 5 more questions on this topic. If you liked this video and found it helpful, make sure to like it, make sure to leave a comment, and make sure to share it with anybody else you know who is going through the CPA exams. Again, if you want to learn more about our strategies, make sure you go to superfastcpa.com and watch our 1-hour free training webinar. There's a link in the description as well, where we teach the 6 key ingredients to passing the CPA exam. It's 1 hour that will save you months and months of struggling. Thanks for watching, and I'll see you in the next one.